The following is paid programming.
It's time to talk taxes.
New friends, new opportunities, new partners. EG Tax.
It's Ask the Tax Lady with Esther Gulius and EG Tax on News Radio 930 WBEN. To reach Esther now, call 803-0930. Toll free at 1-800-616-9236. And cell calls are free at star 930. And now, live from the WBEN studios, it's Esther Gulius.
Hey, everybody, this is the Tax Lady, and this is our hour to talk taxes. And, you know, let's face it, we only just have a little over a month left, and we're dealing with 2017 tax laws and 2018. So whether you got a question about the filing of your 2017 return or getting ready for 2018, you know you can get the very best tax help at EG Tax. And we're here for this hour to answer your questions. I joined in studio with Christopher Fabian. I got him out. Hey, Chris.
Hello, Esther.
How you doing?
I'm doing good. Hanging in there. 2 more returns.
2 more returns today.
Two more returns.
When we leave the office, we say we have to do 2 more returns before we can go home on Saturday night.
You know, and I want to say before we get into our today's topic, you know, what an exciting sports thing we have going on in Buffalo right now with
really
the UB men and women. But
I never even cared about brackets until the other day.
But even bigger, I don't know. I know we're so tired at night, but when I get home, I have to just relax for an hour. And I started watching the Paralympics. I don't know if you've seen any. These are the people with no legs.
Yeah, I know.
What a remarkable! I think NBC dropped the ball. This is what should be on NBC, regular NBC right now, even for an hour a day to get people to watch. Because these people, the sportsmanship,
right?
The great athletes, it's unbelievable to watch them.
Wow, that's great. You're talking because of the hockey?
All
the stuff.
All of it. I mean, there's cross-country skiers with no arms.
Wow.
Could you imagine? I mean, I did it a long time ago, and you mean
you did cross?
I did
with
cross
arms.
With arms,
and it was hard.
I couldn't imagine doing what they do.
Hey, and the other thing, top of the morning to everybody, say Happy St. Patrick's Day.
Yep.
You were telling me that this is the day. Tomorrow is going to be the biggest day in the dental.
In the dental, right? Is what the news has been saying.
And I said it's because they put green.
That's
green
what
dye.
I thought too, but they said no. It's because people are falling drunk on the ground and breaking their teeth.
Anyway, I'm Esther Gulius, the Tax Lady from EG Tax. We have all of our offices open tonight till 5. Our offices are closed tomorrow, but we have 3 mall offices.
3 mall offices. Yep, they're even open till 9 tonight. We have our office in the McKinley Mall. So they're there 9 to 9. We have the Boulevard Mall, and we have the Fashion Outlet in Niagara Falls.
Right, and that's an outpost out in front of the big facility.
Correct.
So if you need help tonight or tomorrow, you can go see those folks. You can call us at our corporate headquarters, 632-7886, or you can call us here in studio where we're talking about taxes. We kind of have a favorite topic of the day, but our topic of the day is going to be employee business expenses and what's deductible now and what's going away next year. And I just want you to understand that when I say employee business expenses, that would be for people that are hired on a W-2. If you are an employer and you have a business, we're going to explain the differential. Basically, for 2018, if you are an employee and you travel for your company, those expenses for travel, entertainment, the expenses that you might have for office and home is going to be completely eliminated. But we're going to help you for 2017 to get everything that you have coming, right?
That's right.
But we have Larry from Atlanta on the phone. Hey, Mr. Larry.
Miss Esther and Chris, hey, my friends, how you doing? Chris?
Good. How you feel, Larry?
Well, darling, every day is a blessing. I tell you, speaking of the Paralympics, Chris, you're right, they're so awesome. But more than that, they really make you think about all your blessings.
Amen.
Amen. Yep.
That's true.
Right? I mean, triple amen to that.
Yep.
And it's just wonderful. Hey, listen, I'm working like a dog, getting myself. but guys, I have a little logistic challenge.
All right.
The challenge is that my plan is to mail my package to you Monday. My challenge is I'm leaving the country on March 26th and won't be back until mid-May.
Wow, that sounds like fun.
It's going to be for Esther, as you know, darling, I travel on the cheap. I stay in youth hostels. I get deals. It's all up to travel.
But that's great. But we'll make sure we get it. We'll make sure we get her done for you.
You're overnighting it, Larry?
Well, I may overnight, but Chris, I wonder, is it better? Look at the calendar.
If it's a problem, we're going to do an extension.
Exactly. But now an extension. Do I need to be here to sign something to send it in, or what? What do you think, Esther?
No, we'll just send it in, Larry.
I mean, if we figure you're going to owe money, we're going to have to send some money in with the extension. But, yeah, you don't have to sign it. We'll just do an electronic extension until October the 15th.
Okay.
Okay, so then you can just go enjoy yourself.
Okay, maybe I should send you I guess, because I don't know if I need to send you a check. I don't.
No. It'd be an electronic debit from your checking account. We'll talk to you.
Okay, sounds good.
All right, have a great time.
Bye-bye.
Thanks, Larry. That was a little business call. I'm Esther Goulias, the tax lady from EG Tax, 8030930, 8030930, star 930 in a cell phone.
By the way, I'm leaving Monday for 2 months, too.
Okay.
Give us a call here. We'll get your questions answered.
So let's talk about the typical employee business expense, all right?
Yep.
So pretty much it goes with your occupation. So if you are an outside salesperson and you're driving around in your vehicle, that mileage is deductible at 53.5 cents a mile, right?
Correct.
And what else would be deductible? And obviously, if the employer is reimbursing the employee, then maybe at 40 cents a mile, the difference between 40 cents and 53.5 cents would be an itemized deduction on a 2106.
Right. Your gifts to clients, you're taking them out to dinner or lunch, your cell phone, your laptop.
All right. Now, but let's be very specific. Taking a client out to lunch, it has to be for business purposes, and you have to be spending the time before, during, and after talking about business items,
yep.
Right? Your cell phone, if you're using it for business and it's not reimbursed by your employer, and these are all things that are not being reimbursed by your employer. Your office and home, maybe you're working out of your home. There's a lot of people that have been trending in that direction. And then you'd be able to take part of your mortgage interest, your property taxes, your utilities, your insurance, everything that goes into managing your home would be part of your office and home expense, right?
Correct.
Education. Let's say you have continuing education. Part of you have to keep your license up, and you go back to school, or the cost of your license, maybe licensure. And I'm not talking driver's license. I'm talking about the license that makes you be able to operate.
Our EA, your nursing license,
right.
Something like that.
So all of those are deductible.
Union dues,
professional dues, the cost of tax preparation, the cost of an attorney, if he or she is helping you to make taxable income.
The cost of your financial person.
All of these things are miscellaneous itemized deductions. If you have any questions about them or anything else, you can give us a call in studio, 8030930, 8030930, star 930 on a cell phone. But suffice it to say, those are a lot of things. So, and we just skimmed the surface.
Yep.
If let's say that your employer sends you out of town, maybe to Erie, Pennsylvania for 6 months because there's a tragedy at one of the offices and they're asking you to go and fill in part-time for a temporary position, those temporary living expenses would be deductible, right?
Correct. Yep.
Well, all of that goes away next year.
It does.
And we're going to talk about we're going to talk about how, and you employers who have employees need to understand that the way that business lunches are conducted has monumentally changed as well. So we're going to help you with that. Again, 8030930, 8030930, star 930 on your cell phone. We're going to take a short break, and we'll be with you and your phone calls on the other side.
Just like the one-winged dove sings a song, sounds like she's singing.
Ooh, ooh, ooh. Hey, this is Esther Goulias, the tax lady from EG Tax, and we want to help you with your taxes. So if you got a question on any topic related to your taxes, give us a jingle, 8030930, 8030930, star 930 on your cell phone. What do you have to say for yourself, Chris?
Call now.
Call
Lines
now.
will be filled
All right,
up soon.
All right, we got Kelly in Niagara Falls. Hi, Kelly.
Good morning. I had a question for you. I filed my taxes the first week of February, and I heard a news report just in passing on a radio station about how something in the tax code changed very week, and it had something to do with homeowners, and I was wondering if you could tell me anything about
Oh, that's so good that you called, Kelly, because we always try to remember to tell people that in the middle of tax season, the fine senators in Congress, when they were doing that budget reconciliation so that the country wouldn't run out of money, passed a whole bunch of tax law changes, but 4 of the primary ones was that your PMI is now deductible, and it wasn't deductible. If you had your taxes done in January, you weren't able to deduct it. Now you can. If you have energy conservation items such as high efficiency doors, windows, hot water tank, high efficiency furnaces, windows, and you haven't matched out at your 500, that's been put back in. The other thing is the tuition and fees deduction is still in there, and there's something else, and I don't remember what. But those things, if you did your taxes in January or before February, before they put these things back in and they're retroactive, you would amend your return and get your money back.
Okay, thank you very much.
All right, thanks, Kelly. Thanks for calling. And I tell my clients, they'll say, well, what about next year? And we do the whole thing, and I'll say, that's if they don't change the law.
Yeah.
And they say, well, they can't change the law. And I say, well, yeah, look at this,
Yep.
So if you are somebody that filed early and you are wondering do we have it on our website, by the way?
I believe we do. I'll double check with Tim.
Yeah, so check our website out, and then we'll tell you there's some things with horses and depreciation, but the big ones were the PMI, the tuition and fees,
and the energy.
And there was something, there's one other one. Darn, I can't remember. But I'll probably remember it and let you know before the end of the show. I'm Esther Gulias, the tax lady from EG Tax, 8030930, 8030930, star 930 on your cell phone, and we got Dorothy in Silver Creek. Hi, Dorothy. How can we help you, ma'am?
Oh, I have just a simple question. Esther, I had my taxes done at Vita.
Yeah.
So that Vita program.
Vita, yeah.
I listened to you faithfully. You've got a great program.
Thank you.
And what you kept saying was that the maintenance money that I received from my husband, I do not have to pay the income tax.
After 2019.
Oh, that means I have to pay it.
No. It has to be a 2019
divorce. A new divorce.
A new divorce.
Oh.
After 2019. So you must have skipped into the Vita people and thought, wow, I don't have to pay taxes this year. But unfortunately, you would have had a pre-2019 divorce. So alimony is not taxable nor deductible on newly written divorce decrees in 2019 going forward.
All right. And so
unless they change the law.
I'm still here. And
you're still stuck.
Pay all that money.
That's right.
Oh, dear God. Okay, well, because I just got it back from my aide brought it, my papers.
Yep.
And I really have poor vision, and I couldn't read it, and I thought better ask you.
Yep.
Inside of my folder must be my estimate forms.
I don't know. I didn't do them, but if you're getting alimony, you want to make sure you prepay your taxes so you don't owe more than $1,000.
I always do.
Okay.
Okay, honey. Thanks.
All right. Thanks, Dorothy. And the other thing is she wants to make sure, there's going to be, for most brackets, the 10% bracket's not going to change. But for most other brackets, there's a 2%
Right,
reduction.
It goes to the 12 and
so
22.
She wants to make sure that she doesn't overpay her estimates because in many situations, people are going to pay less.
Yep.
In some situations, people are going to pay more. Right? And so that's what you have to make sure that you understand what's going to happen in 2018 while you're doing your 2017 return. As a matter of fact, this morning I was doing a tax return for a lovely couple, and they ended up owing about $1,400. And but they would qualify for a traditional IRA. And they really weren't wealthy. But this lady, she's very shrewd, and I thought, if anybody's got money squirreled away, this lady does. So I said, and inside of my head I thought, I bet you they don't want to. But I asked, I said, would you like to get rid of this liability? And they said, you'd like to. So I said, put $6,500 in a traditional IRA. So we did the math. Then they qualified for the pension savers credit. So they got all their money back.
Yep.
And they were dancing in my office. They were so happy. So there are things that you can do. And anybody that's receiving taxable alimony, I'm saying all that to say this, you could put money into it. But I think she's over the age of maybe, she might be over 70 and a half.
Yeah.
So she wouldn't be able to. But if she was under 70 and a half, she could put money into an IRA. And that would save her some money.
Definitely.
And she could do it up till April the 15th. Okay, let's go back to the phones. We got Christine in Cheektowaga. Hey, Christine.
Hello.
Hello.
Oh, thank you for taking my call.
Yes, ma'am. Honored to do it. What can we help you with?
Kind of simple, I guess. I am a senior citizen.
Okay.
And I only have Social Security for income. So the past 3 years, I've never done an income tax return because I was told you don't really have to if Social Security is your only income. So I didn't know if that changed. My Social Security, including the gross, is $27,600. But I do have a $5,000 IRA that I took.
Uh-huh.
And then this year I canceled the savings bond, so I got $1,500 in interest. Am I still okay to not do a form?
Okay, so you're fine.
Oh, okay.
You're fine. But just to let you know, next year with the standard deduction, and are you over 65?
Yes, I'm 75.
So you can take out like $13,500 and still out of your IRA and still not pay taxes. So what you want to do is take a look at taking out systematically money out of your IRA, even if you're not 70 and a half, because you'll take it out tax-free.
Yeah. Okay. Well, like I said, I took a lump sum of $5,000. So
well, you can even do more, is what I'm saying.
Okay. Next year, though, not this year.
Well, this year.
2018.
Yeah.
Oh, okay, because I was so concerned I was going to take out more, but I thought...
No, and as a matter of fact, if you want, and anybody that wants to, you can give us your Social Security figures. We'll tell you exactly how much you can take out and still not pay any taxes. And that's the way to get around the fact that you didn't have a Roth. A lot of people will say, I got to put money in a Roth so it won't be taxable when I take it out. If you're smart, many people can take it out
anyway,
and not pay taxes.
I only have a balance of $9,000 left in my IRA.
Okay, well, I'm pretty sure you can take it all out, Christine, and not pay taxes at all in it.
Right. But even though I get $1,500 in interest, that's still okay.
Yeah, because you'll be fine.
Okay, and then again, is there a certain quota of how much Social Security and income you get before you have to do an income tax return?
For a single person, well, no, it would be 13, not counting Social Security. For someone over 65 would be
13.5.
I mean, if it's just Social Security, is there a limit?
You don't. Social Security is not taxable until half of your Social Security exceeds $25,000 if you're single.
All right,
so you're good. You're good to go.
Thank
you. Thank you, dear.
Okay.
Bye-bye. I'm Esther Gulius, the tax lady from EG Tax, 8030930, 8030930, star 930 on your cell phone. We're going to go to Mary in East Aurora. Hi, Mary.
Hi. I have a question, Esther, about being a private contractor and wondering at the federal level what type of expenses are deductible.
Well, if you're a subcontractor, if you're self-employed, it would be any and all expenses ordinary and necessary needed to do your job. So that would be your mileage, driving places, your supplies, your cell phone if you need your cell phone. If you do stuff from home and online, it would be your part of your internet.
Okay.
So anything, just exactly like Chris was saying, if it's ordinary and necessary for you to perform a function. Now, I will tell you that employee business expenses and meals are substantially changing in 2018. So meals that you would be providing your employees may not be deductible to you unless they fit into certain perimeters. We're going to talk about that in the second half of the show. But pretty much everything else is going to be deductible if it's ordinary necessary.
Okay, and I have no one working for me. I just work for someone, but they pay me as a private contractor.
Okay, and do you ever entertain?
Not.
You don't take people out to lunch?
No.
Okay.
Okay.
All right?
Okay, thank you.
Thank you, dear. Because if Mary took them out to lunch, it wouldn't be deductible anymore.
Yep.
So, no matter if you're an employee or not an employee, if you're taking people out to lunch, and this is especially important for you outside salespeople right now or self-employed people, if you're entertaining, you can't. There is no deductibility anymore. Let's see. We'll go to Mike in Hamburg. Hi, Mike. Mike?
Got to turn down your
Mike,
radio.
you got to turn down your radio. You know what, Mike? We're getting ready to go to the news. I'm going to put you back on hold, and we're going to talk to you on the other side. Is that okay?
Yes, Esther.
Okay, Mike. I'm Esther Golias, the tax lady from EG Tax, 803-0930, 803-0930, star 930 on your cell phone. We're going to break for the news. We'll see you on the other side. Hey, this is Esther Golias, the tax lady from EG Tax. We have all of our offices open tonight till 5. Our 3 mall offices are open tonight till 9. Our 3 mall offices are open on Sunday. And the rest of our offices are open 9 to 9, Monday through Friday, right?
Right.
And if you need to talk to somebody, you can actually call and talk to a person. And if you have any questions, you can email us through our website at egtax.com, and we'll get right back to you. Let's go back to Mike. Let's see if he's ready. Hey, Mike, are you there? Hello, Mike.
I'm here.
Okay, what can we help you with, sir?
I got 2 questions. First question is, my wife passed away last November, and I need to know what I'm supposed to do, for her signature if I'm filing a joint return.
Okay, you don't need her signature. You're just going to make sure that you mark the return that she passed away, that you have the date of death on there, and you would just sign your portion of the return.
Okay, where would I mark that?
Under taxpayer, you sign it.
Well, up on the top. At the top of the 1040 page 1, you would put
deceased.
Yeah, her name and put deceased and the date of death.
Okay, and the second question was, I got a 1099-B in the mail, and I have to file a Schedule D, but do I still have to file a 8949 if I have no adjustments for the short-term and long-term transactions?
Yes, you do.
I do.
Yep. The 8949 is the sub-form to the Schedule D now, so they would, if you don't send it in, they will send your return back saying you don't have all the forms.
Okay, but on the Schedule D, it says if I don't have any adjustments,
we're just letting you know what we've seen.
Okay.
And it's not hard. I mean, it's just basically
it's the same
over
thing.
Figures. It's very simple to do. You're basically taking the figures from your Schedule D and putting them on that form.
Oh, okay.
Okay?
All right. Thank you.
Thank you, sir.
Yeah, especially with the A, B, C, D, E, F.
Right. And we're going to go back to the phones. We're going to talk to Gary in Lockport. Hi, Gary.
Hi. Thanks for taking my call.
Yeah.
I had a question. 401k contribution. Can I make one now, going back to 2017?
No, you can't. You can make an SEP. Are you self-employed?
No.
No, that had to be done in the calendar year. And then if you were self-employed, you could do a 401k contribution now.
Right. And depending on your income, you may be able to do a 401k. Not a 401, an IRA, sorry.
Right.
I'm over the threshold.
Oh, your income's too high? Yeah. Are you married?
No.
Okay.
Okay, yeah, so that had to be done through your employer. So you want to make sure that you are maximizing your 401k plan this year so that you don't get caught short next year.
Right. Okay, very good. Thanks.
Thank you. Bye-bye. Let's see. Oh,
Al.
yeah. Oh, yeah, that's right. Poor Al. He's been waiting for so long. Hi, Al. How can we help you, sir?
Hey, good afternoon. I just had a quick question. I know that there's some ways of not delaying, but not paying the capital gains by exchanging.
A 1031 exchange.
Yeah, so I wanted to know if I sold a house here in Western New York and I was buying it in a different state, how much time would I have before I lose that benefit?
Well,
And we're talking a business asset, correct?
Right, it would be a rental property.
Okay, so the thing is, you can't have already sold it. It has to be, because the whole thing is you cannot get any cash. And so if you've sold it and you've already gotten cash, you've already eliminated the possibility of the 1031 exchange.
And that's
so what you need to do is, as soon as you get that contract that says, "Hi, Al, I want to buy your rental," that's when you want to make sure you talk to your exchanger. Now, Russ Gullo is who we recommend. And then Russ would then become the intermediary who would then take title temporarily while you're identifying the new place that you're going to exchange that house in Buffalo for. And then he kind of does a magical thing. And then you have the new place and the old place is sold between him and
you have 45 days to identify the new property after you sell the old one. Exchange. And you have to complete the whole thing in 180 days.
Okay, so basically I got 45 days and 180 days, and that's exactly what I need to know. And what is this gentleman's name that you use?
Russ Gullo. There's very few intermediaries in the United States, and Russ Gullo's right here in Western New York. So,
how do you spell his last name?
Gullo.
Okay.
Okay.
Thank you very much.
All right. Thanks a lot. Let's see. We're going to go to Al. Another Al. Hey, Al. This is Esther. How can we help you, sir?
Hi. Can you hear me?
I can hear you.
Great. If you're receiving an RMD from an inherited IRA, can you still contribute to a traditional IRA?
Sure.
As long as you have.
Yeah, you're taking money out of an IRA, and you're wondering, can I put money into an IRA? Chris is going to say, as long as you have wages.
As long as you have earned income.
Right.
Okay. Now,
and you're under the age of 70 and a half.
Yes. If the only money that you would have to put into the traditional is the money that has come out of the inherited, does that make any sense, or is that like just double taxing?
No. So, if you have, do you have wages?
Yes.
Okay, so on this side of the ledger is the wages. And so you also have, on this side of the left side of the ledger, the income side, you have an IRA. Then, but to reduce this year's tax liability, you might say, well, I'd like to make a contribution to my traditional IRA. That it's creating a deduction. And it's actually putting money into the pension plan that can be used at a later date. So you're saving money and creating a tax deduction now, and you're putting money into a pension that you can use later on. And if you don't do that, that's fine. But if you wanted the deduction, that's a way to create a deduction.
Right, I understand that. But if the only... Well,
no, that's fine. As long as because it's new money to you coming out of the beneficial IRA. Right. So you can put that in an IRA for you, because the beneficial IRA we'll say mom's, not yours. So that's new money to you.
Right. And it's like they don't care where you got the 10. Let's say you're putting in $6,500. They don't care where you got it from.
Right.
You got it from mom's IRA, let's say. So let's say mom's IRA gave you $10,000, but you want to create a deduction this year. You are doing your return and you say, oh, gee, I would owe money. But if I put $6,500 into a traditional IRA, I'm going to save $1,400. And so you say, gee, I'd rather save the $1,400. And I got the extra money to do it, so I will. It works for some people, and some people say, I don't care about the deduction. But it's just like any deduction. it's available to you. If you want to make yourself available, you can. If you don't want to, then don't do it.
It's actually good tax planning there, Al. I mean, what I tell some of my clients is to up their 401k contributions, especially if the company's matching, because then you're getting the money to offset your paycheck that you're losing. Well, not losing, but going into your 401k, you're getting it through your beneficial IRA.
Right. Now, the whole thing is on the beneficial IRA that you're inheriting, you were going to get that money anyway. And so when you put fresh money into an IRA for you, basically it's making the money that you got from the beneficial IRA almost non-taxable because you're covering one with the other.
I understand.
Okay?
All right, exactly what I needed to know.
All right, thank you. Bye-bye. I'm Esther Gulius, the tax lady from EG Tax with Chris Fabian, my right-hand guy. And if you got any questions, 8030930, 8030930. Star 930 on a cell phone, and we're going to go to Dave in Lancaster. Hi, David. How can we help you, sir?
Hi. Thanks for taking my call.
My pleasure.
Okay, so I've been following this new Trump tax law.
Yep.
I've been listening to you, and I haven't heard any. I have 2 kids in college, and I'm wondering, has there been any changes to the American Opportunity Act and the Lifetime Learning?
All right, so here's the main changes. The main changes under the Trump tax law is that there is an elimination of the deductibility of meals and entertainment by pretty much everybody. All right? There are no employee business expenses. They've eliminated the miscellaneous itemized deduction on the Schedule A. But the Schedule A, which includes contributions, taxes limited to $10,000, mortgage interest, charity, and some gamble and some non-limited 2% miscellaneous itemized deductions are still there. Everything else is the same, except that the tax rates have dropped 2 to 3%. The child tax credit has doubled from $1,000 to $2,000, and they've extended the opportunity to take the child tax credit to much higher income earners, and there is this phenomenal pass-through for businesses of 20% of your net profit, whether you have a business, S-corp, partnership, or rental property.
Yep.
Did I sum it up?
And to answer your question, they did not change the American Opportunity Tax Credit.
Yeah,
it's still there.
Everything else is there.
Okay, cool. Now, the next question that I have is there is a stipulation on the New York State income tax that if you take the standard deduction on your federal tax, which you have to do now because it would be more advantageous for me to do that, then you have to take the standard deduction on your state tax. And there is actually a bill that's being floated through the New York Senate, Bill 6974A, that's trying to unravel that. However, if that doesn't pass, if I have to take the standard deduction on my federal...
You're going to get screwed.
Yes.
I know.
Especially when it comes to college tax credit.
I know. And so, the college credit is a credit, and it's not an itemized deduction.
I can still take...
Oh, okay, except that, excuse me, it's a credit or an itemized deduction, depending upon...
On New York State. On New York State.
But I think, I think everybody kind of has to buckle up their seatbelts for this thing, because I do believe New York State may make it so you can itemize on New York State, even if you don't itemize on the federal.
Well, last I contacted my a representative. The bill is stalled in the House Appropriation, or the New York State Appropriation
Committee,
Department Committee, whatever it is. But so it doesn't seem to be going anywhere. So I'm assuming that that's not going to happen.
Well, you can never tell with a politician, though, can you? I mean, you just can never tell. But I do believe New York State's going to do something, because it would take our high tax state and even make it higher.
Right.
True.
Okay, third question, and this is a short one. I was one of these people that paid my 2018 property taxes
up front
in 2017. Is that deductible on my 2017 tax form?
You live in Erie or Niagara County?
No.
Okay, those are the counties I know of that did get the warrants out there issued in time. You would have to check with your local municipality to see if they had the tax warrants
the
issued.
governors did the special law, right? And said that if the municipality went along with it, that they could issue the warrants so that the bills could be paid. So you would have to make sure that you had a duly issued warrant by your municipality, and only they can say.
All right, cool.
Okay. All right. Thank you.
All right, bye.
Thanks for calling.
You were talking about more taxes in New York State. One of my clients told me today that it was either Massachusetts or Connecticut is trying to pass a exit tax. So when you leave,
you have to pay.
You have to pay. And they said,
you mean you move out of the
you
state?
move out of the state, you're going to pay them for moving out. They said, how fast do you think New York's going to pass that law?
I know. If they could get you, all right, and let's go to my mystery caller. Hi, this is Esther. How can I help you?
Oh, hi. My question is regarding the standard deduction for 2018.
Yeah.
You stated that goals it'll be 13.
Well, if you're a senior
and you're
single, then you're going to get
like an extra $1,250, so it would be $13,250.
Right.
Okay, so right now my deduction is $7,900 because I was born before January 2nd, 1953. Will that $7,900 double?
Nope. You're going to get the standard deduction for a single person is going up to $12,000, plus you're going to get an extra $1,350 or $1,250. So it's going to go up to $13,250 for you next year.
Right.
It's not a true double.
Right. Now the exemptions, will that still be?
The exemptions are gone.
So actually I'm not doing that well.
Honey, if you knew, as soon as we read the law back whenever it was, it seems
December.
like years ago, we said, this is not double. We're doubling the standard deduction, but we're taking away the personal exemption. So there are numbers, and I don't know what percentage, maybe 30% of the people that are doing very well because of this, and maybe 30% who are not doing well at all. And somewhere in between, people are getting refunds, an extra tax cut of $200 to $500. In your situation, though, you're losing your standard deduction this year with personal exemptions $12,800, and you're going to $13,500. So you're going to get a little bit more bang for your buck, but not much.
Oh, thank you very much.
All right. Thank you, dear.
Bye.
Bye-bye. I'm Esther Gulius, the tax lady from EG Tax, 8030930, 8030930, star 930 cell phone. You look like the
one of my clients goes, what is this with that? I said, well, what they did was they started telling you this really positive stuff, and then they said, squirrel! And when your attention was looking somewhere else, they said, and we're taking away your personal exemptions. Isn't it great? We're doubling your standard deduction.
And the other thing that's interesting to me is we haven't seen how this all fleshes out yet.
Yep.
Like, I do not know, if they don't have personal exemptions, how they're going to keep track of who is the head of a household, who gets the qualified child, who gets the education. How do they do this?
How are they going to work?
They're going to have to come up with some kind of a new form,
which
they don't want to do, but there's going to be some kind of voodoo in here, because how are they going to do it?
And then that extra $500 credit they created for claiming somebody else who's not a child.
That's right.
Well, define not a child.
Right. So that'll be interesting, too. All right, let's go back to the phones, and we'll talk to Dave on a cell. Hi, Dave.
Hi, how are you, honey?
Good.
Okay, this is a question for my daughter. She's a waitress, and I think she makes anywhere from $16,000 to $20,000 per year.
Okay.
Now, she's getting separated or divorced from her husband, regardless of the situation, but she's going to be filing separately, okay? And she's going to be claiming head of household. Now,
wait. Before you do this, Dave, does she have a child?
No, she got 2 children. All
right, she does. And how long has she and her spouse not been together?
Well, he's not out of the house typically right now. I mean, legally. but he's been out of the house for about 6 months.
Okay, so does he live in the house?
No, he does not.
When did he move?
She kicked him out about 4 or 5 months ago.
Okay, she can't be head of the household. She has to be married filing separately. In order to be married separate, you have to have maintained a household for the last 6 months of the tax year. So that would be July, August, September, October, November, and December for
18.
Pardon me?
For 2018.
For 2018, he's
She's going to be
yeah,
golden.
She's good.
Okay, but my question to you is, how much was she going to be able to get as an earned income credit?
Well, she'll do very well because she's going to fall at the maximum of the earned income credit because the maximum earned income credit is right between those levels. So I'm thinking off the top of my head about $4,500.
Right, and then how old are the children?
2 and 9.
So she'll
and
get a
plus-
$1,400 refundable child tax credit. So she will be doing really well next
She'll
tax
be
time.
a happy camper.
For a child?
Yep.
Yeah. Well, it's a $2,000 child tax credit with a $1,400 refundable feature.
And then she'll get the earned income credit
on top of that.
Really? So she'll get almost 10 grand.
Yep. Not to mention New York State.
Yep.
All right. The other question is for me. Now, you're saying New York State, and this is I would assume not in stone yet. They will allow for itemized deduction?
No. I'm saying that's what they're floating around because the standard deduction, what you do on the federal, you have to do on the state. So if there's only a standard, people are only taking a standard deduction, it especially hurts New York State taxpayers who would have been able to itemize. And so to reconcile that, part of what they're talking about is letting New Yorkers itemize.
But that's not in stone yet.
Not at all.
Yeah, right. Okie dokie. Have a nice day.
All right. Thanks a lot. Thanks for calling. And we got Mark. Hey, Mark, how can we help you, sir? Hello, Mark.
No, I have a question.
Yeah.
I have a question about my 18-year-old son.
Okay.
Locally, makes about $6,000 a year.
Uh-huh.
And I have a TMA account for him that I started with the baby. It's got about $25,000 in it.
Mm-hmm.
And my question is, can I take money out of that and roll it into a Roth IRA for him now that he's 18?
Well, all right. The UGMA account is his money, right? And he's making $6,000. Am I saying this correctly?
Yes.
All right. So he's got wages, so he can get a.
But if he's a dependent of somebody, can he still put in a Roth? Can he still put in an IRA?
Yeah.
I thought with being a dependent, you're not allowed to yet. That's just I'm just thinking, sorry. This is why we research things too.
No, he can put.
Okay.
He can do he can put it in a Roth. So yeah, I can't see why not. Chris and I are having a gentleman's agreement. You want email me at egtax@hotmail.com and I'll let you know definitively. Okay, Mark?
I'll send you an email.
All right, thank you, sir. I'm Esther Golias, the tax lady from EG Tax. 803. Oh no, we're leaving for the day. Let me quickly say this though. Here's what's not deductible for 2018. If you're entertaining and you have a business, if they're taking clients out to lunch, it's not deductible. Holiday meals and picnics for your staff is 100% deductible. Business meetings for stockholders and directors, 50% deductible. Lunch with a client out of in town, not deductible. Lunch with a client out of town, 50% for the employee, nothing for the client. And so if you're a business owner, you want to make sure that you look at these regs because you want to make sure that your employees know what they can deduct and what you can deduct on your tax return. Until next week, I'm Esther Golias, the tax lady. Give us a jingle at EG Tax. Stop in at any of our offices. Thank you for listening, and we'll see you next Saturday.